In February of this year, financial media reported a sudden crash in the price of silver. But while retail investors watched those digital tickers fall, 39 million ounces of physical silver quietly vanished from the vaults of the COMEX exchange. To understand the scale of that withdrawal, you have to look past the paper contracts and weigh the actual metal. 39 million ounces equates to over 2 million pounds of physical silver leaving the ecosystem. Logistics at this level require extreme coordination. You don't move 2 million pounds of precious metal in the trunk of a car. It requires fleets of armored semi-trucks, advanced insurance policies, and highly sophisticated investors who know exactly where to store it securely. Retail traders routinely panic and sell when they see red numbers on a screen, but the world's deepest pockets ignore the screen entirely, using those engineered price drops to orchestrate massive physical loadouts. The digital price of silver on Western exchanges relies heavily on the assumption that the system operates fairly. Yet, since Thanksgiving, these markets have experienced repeated glitches and failures of standard circuit breakers that are designed to prevent sudden market crashes. Look at what happened during the January crash. The CME Group suddenly hiked margin requirements by 300%. Margin is simply the cash kept on deposit. By tripling that requirement, they forced speculators to sell, driving the price down. The Bank of International Settlements noted this drop was structural. It was driven by exchange mechanics and forced liquidations, not by any actual shift in the global supply and demand for silver. The financial system is operating exactly as designed. Exchange rules are actively weaponized to push paper prices down, shaking out retail speculators, while massive institutions quietly secure physical assets at a steep discount. This chart tracks global silver mining output against market demand, and it shows 7 consecutive years of strict structural deficits. UBS estimates that this year alone, the market will experience a massive shortfall of 293 million ounces. Mining companies cannot simply dig up more silver to fill that gap. The vast majority of global silver is actually a byproduct. It is extracted during the mining of other industrial metals, like copper, lead, and zinc. To pull those primary metals out of the ground, operations rely heavily on sulfuric acid. Right now, China is implementing strict new limits on their sulfuric acid exports. Throttling that chemical supply directly restricts global copper mining, which in turn chokes off the primary source of newly mined silver. Western financial exchanges possess the ability to print infinite digital contracts representing silver. They cannot, however, print the sulfuric acid or the physical ore required to actually close a 293 million ounces. When Western governments confiscated Russian treasury bonds, they inadvertently broadcast a harsh lesson in counterparty risk. They proved that holding your wealth in a foreign digital ledger means that wealth can be frozen or erased overnight. As a direct result, even steadfast allied nations are rethinking their storage arrangements. Both France and Poland have formally demanded the repatriation of their physical gold reserves, pulling their metal out of the vaults at the New York Federal Reserve and bringing it home. Look at this graph comparing China's historical silver demand against early this year. When the CME Group used margin hikes to crash the paper price in January, China didn't panic. They used the artificially suppressed price as a massive subsidy, and their silver imports spiked exactly 173% above the 10-year average in February and March. Simultaneously, China has aggressively halved its holdings of U.S. Treasury bonds while accumulating bulk physical gold for 17 consecutive months. The nations responsible for producing the world's tangible goods no longer trust Western paper promises. They have run the math, recognized the supply deficits, and decided that taking physical delivery is the only logical defensive strategy. This quiet reallocation isn't limited to foreign central banks. Inside Wall Street, institutions like BlackRock, Bank of America, and Wells Fargo are quietly abandoning the traditional 60-40 investment portfolio. The chief analysts at these banks are now advising clients to sell off portions of their bond holdings and rotate heavily into hard commodities. They are actively front-running geopolitical disorder and sticky inflation by acquiring the exact same hard assets that foreign governments are stockpiling. This scale visualizes a clear data point regarding global reserves. For the first time in modern history, central banks around the world now hold more physical gold in their foreign reserves than they do U.S. Treasury bonds. As the rest of the world demands transparency and physical possession, the United States takes the opposite approach. The official gold reserves held at Fort Knox have not undergone a comprehensive, independent audit since the early 1950s. The math of the mining deficit is completely detached from the digital ticker on the exchange. You have to decide whether you want to hold the glitching paper contracts of an over-leveraged system or take physical possession of the actual assets the smartest money in the world is currently loading onto trucks.